Hey there, Annie and Julie here. We just wanted to pop in real quick before we dive into this episode and announce our new show name. We're excited to announce that we're rebranding the Investing for Good podcast as the Life and Money Show. Now, this new name reflects the broad focus of our episodes and guests thus far and allows us to tell even more stories about living a meaningful and intentional life by design while also making an impact. We're extremely grateful for your support and listenership as we've grown this podcast and are excited to begin this new chapter so we can bring you even more valuable stories and insights. With that, let's dive into the episode.
Storage is kind of interesting though, in that it's not just the real estate play. It's like an operating business layered with real estate because the tenant's leases are 30 days. So there's a lot of churn.
You're listening to The Life and Money Show, a podcast that brings you the stories and strategies of people who are living a meaningful and intentional life by design, building true wealth for their families, and impacting the world around them. And now here are your hosts, Annie Dickerson and Julie Lamb.
Hey everyone, Annie Dickerson here together with Julie Lamb. Julie, how are you today?
I'm doing excellent, Annie. I was going to ask you, how is your homeschooling going with Kai?
It's going well. We're actually homeschooling both of our kids now, and we're doing the unschooling methodology, which is basically you just self-directed education. So we sort of let the kids explore and go deep on what they're interested in. And right now they're both really into Minecraft, which I had never, I have a game design background, but Minecraft was just coming out when I was in game design school back, over 10 years ago now. I didn't know much about it. It's like this blocky world. I'm like, is it like Legos, but on the screen? And I didn't really understand. But now watching them in there, it's like an incredible, it's a whole world and you can really do anything in there. So they do all sorts of like experiments in there, architecture, engineering. They like make all these plans for each other. And coming up is Eli's birthday. So Kai's going to make this like birthday obstacle course thing in Minecraft. So they're having a blast.
Nice. So Eli's getting Minecraft at 5. He understands.
Oh yeah.
Because then I need to tell Chloe she needs to work on her Minecraft skills. She's almost 8 and she can't figure it out. So I've got to have a little.
There's a learning curve for sure. Well, anyway, our conversation today focuses not so much on Minecraft, but I guess on building structures. I guess that could be the connection there. But specifically on self-storage. And so today we're speaking with Kris Benson. He's the Chief Investment Officer for Reliant Real Estate Management. And, I don't know a ton about self-storage. I personally have not used a self-storage unit. So in this episode, I got to ask Kris a bunch of questions around, well, how does it work? When do people use self-storage? How is it so recession resilient as so many people are talking about? So we really got to learn more about how self-storage works and who it's right for.
Yeah. And I thought it's such a great time to be talking about this asset class as we're moving into a time period of a lot of unknowns. There's a lot of things that we don't know what's going to happen in the economy. And so it's a great time to think about diversification. And so, if anyone listening is really into multifamily, it might be a good idea to start thinking about self-storage or thinking about, mobile home parks and just these different asset classes so that you can take your pot of gold and kind of diversify it amongst different things. But one of the things that I thought was really interesting when we asked Kris about, what are the demand drivers for storage? He kind of listed them. He said they always look at the 4 Ds, which are death, dislocation, downsizing, and divorce. And when you look at, all of those things, you start to really understand the capacity for the demand in this asset class. And it was such a great, interesting conversation with somebody who's been in the business for a while.
Indeed. And he talked a lot about how, even surprises can come up when you invest in self-storage and red flags to watch out for and the whole gamut. Just so, all of our listeners, if you're getting into this space, this is a great episode to help you get up and running with all the basics of what you need to understand when it comes to investing in self-storage. Speaking of which, if you are new to the world of real estate syndications, whether it's in self-storage or a multifamily or any other asset class, a great place to start is with our book. It's called Investing for Good, and we have a free hardcover copy for all of you. Just go to goodegginvestments.com/book. All right. And with that, let's dive into our conversation with Kris Benson. Kris, welcome to the show. How are you?
I'm doing great. Thanks for having me.
Now, Kris, I believe our paths first crossed when we partnered together on a self-storage investment a few years ago. And at the time, I knew nothing about self-storage and why it was such a great investment. But as a result of that investment and some others, I now know just barely enough about self-storage, I would say, to be dangerous, but I certainly don't have the level of expertise that you do when it comes to self-storage, which is why we're so excited to dig in further with you today. So to start us off, tell us how you got into self-storage in the first place. I mean, it seems like such a niche asset class. I mean, did you just stumble into it, or had you been involved in other types of real estate investing first?
Yeah, it's a fair question. Self-storage now is kind of a sexy asset class. I mean, people know about it, but 10 years ago, self-storage was one of those things that no one knew about and was always kind of, out in a rural area behind somebody's house on a gravel.
Right. So, you would never have spoken self-storage and sexy in the same sentence back then.
That's very true. That's very true. Well, so, my background, I came from other asset classes, primarily residential. We kind of followed the path that many real estate investors find or follow, which is, they're investing in the town that they live in some small multifamily, whether it be duplexes or quads or those types of things. And I quickly realized that it was going to be very challenging to scale that business for what I wanted to do personally. And so we ended up getting into some multifamily, both direct. We did some of our own projects. We developed a 64 unit apartment complex from the ground up. And then also on the passive side, Annie. So we were investing in some passive multifamily projects across the country as well. And interestingly, what kind of prompted me into self-storage was one of those groups that we invested with. This was almost 5 years ago now, said, hey, cap rates have compressed to a point where we think we're going to stop buying stuff. And, that was 5 years ago. Cap rates have probably only compressed more so on the multifamily side. And so that really opened my eyes to say, maybe I should be looking at some other asset classes along the way here. And I'm a data guy, Annie. So there's a data set that I love to reference from the National Association of REITs. And essentially what it tracks is all of the publicly traded REITs across the sphere. So literally, if there is a real estate investment trust that is publicly traded, these guys track it. And the data set is pretty long-standing historically. So, I went back to the National Association of REITs and basically started looking and saying, all right, what asset classes have performed well. Storage did just under 17% over the last 25 years, which is incredible. Outperformed apartments, retail, office. So that was encouraging. And then, the second thing I always look at is I'm a big believer that everything is cyclical, right? So, if it's going to happen, it's probably already happened in the past. You just need to look back far enough to see it. And so, looking back at 2007, 8, 9 at the time was our, most recent economic reset. And storage did really well during that time period as well. Lost less than, I think it was just under 4%. Apartments was closer to 7%, retail, 8, 9%. Office got double-digit loss. And then obviously the S&P 500 got crushed during that same time period. So now I had this historical asset class that had done really well in the past and had some downside protection. And then the third thing that just kind of doing some homework that I found was, and this is most interesting as far as a future runway, is the ownership in self-storage is very fragmented. So there are 5 publicly traded REITs in the space that own about 25% of the market. And then the rest is very fragmented, meaning there's still a lot of one-off owners, what we call mom and pop type owners. And at Reliant, our strategy has really been built around value add type deals. And that's kind of ripe for the picking in that regard. So it really allows for a consolidation or a roll-up strategy type of play. And so for me, that's kind of what brought me to self-storage. I was an investor with Reliant first, just passive investor. And then we had built up a relationship. They needed some help raising capital, and I had some experience doing that. And so that's kind of where the partnership formed.
So, okay. So take us back, because there's so much in that story. And I love the data angle too, and definitely want to dig into the value aspect of self-storage. But so taking a step back, I think pretty much everybody listening to this call has lived in an apartment before. So they understand multifamily. They get it, right? You go in, you sign a lease, you pay your rent, and that's where the income comes from. There's some maintenance and repairs and maybe some upgrades to the kitchen, the flooring. So people tend to understand that at a pretty basic level. When it comes to self-storage, I think a lot of people don't have that same experience. A lot of people, like I have very limited personal experience with self-storage. So can you talk to us a little bit about how self-storage works and why it's such recession-resistant asset class?
Yeah, I mean, it's a garage, right?
Yeah.
I mean, at its most basic level, it's either a heated and air-conditioned garage or a non-heated and air-conditioned garage. So I mean, I think it's rooted in the idea that Americans don't get rid of stuff, right? You know, when times are good, people buy more stuff and it goes into storage, right? And when times are bad, people have this, mindset that they're going to someday need that and they don't get rid of it. And Annie, I can't tell you that I am a personal purveyor of self-storage. I have a house with a big basement and a couple garages. And so I don't use a storage unit. We actually have a boat and a trailer that are in a storage unit because our neighborhood won't let you have them there. But other than that, we don't use it. And, it's interesting. We talk about kind of the 4 Ds of demand when it comes to self-storage. And those are death, dislocation, downsizing, and divorce, right? Generally, all that rolls up into transition. If you have transition in your life, generally you have a need for self-storage. When we moved from New York to Georgia, we had 3 self-storage units where our stuff was before we bought a house. So, and that was part of the transition in our lives. So, that's generally what drives it. And when you talk about the recession resiliency part, fortunately for us, unfortunately for the general population, COVID's a great example, right? We're recording this end of February, very much still in the throes of COVID. Well, if you think about those 4 Ds, generally COVID is creating more of all of that, even the divorce piece. So we have an investor who's runs one of the largest divorce practices in the state of New Jersey. And 2020 is the best year he's ever had. And he's in his late 60s. He's been in business for 60 plus or 25 plus years. So it has created a lot of all of those 4 Ds, and we've certainly been the beneficiary of that. The second thing to think about is it's a relatively small amount of your disposable income. When you think about a storage unit, think $100, $150 for a 10 by 10 type of unit, depending on the market you live in. Certainly, some of the larger metroplexes, it's larger. But so it's like a gym membership. It kind of gets pushed down on the bucket list of things to cancel, and it's usually auto debited. And so people just forget about it. It's just there. It just happens. And, generally not motivated to go move their stuff.
Yeah, it seems like a big hassle. If you've got like a boat in there or like, all these yearbooks from high school, like the last thing you want to do when you're going through one of the, the big life changes, have to go in there and go and move everything out, figure out what to do with it. So remind us again of those 4 Ds. Yeah,
it's death, dislocation, downsizing, and divorce.
Okay. So often that's what kicks somebody into getting a self-storage unit in the first place. And then what do you see? Do people tend to stay long-term? Is it usually like a, 3 to 6 month window that they're staying, or usually are people holding their stuff in there for years at a time?
Yeah, it's market specific, Annie. I mean, you think of your self-storage customers as 2 distinct groups, right? One is residential, right? So, I would be a residential customer if I'm going and, to your point, storing my high school yearbooks in there. And then we have commercial tenants, right? So people who are running small businesses essentially out of their storage units. Sometimes they're using it for equipment storage. We have some, Just as an example, we have online retailers, and that's their warehouse space. So, it really depends. Generally, the commercial tenants are staying longer, somewhere in that 24 to 28 month range. The residential tenants, usually a shorter term stay. 12 to 14 months is generally where we see our portfolio, but there are some markets where that could be shorter or longer.
Got it. And then when you say that you're buying these with an eye on the value add potential, so I'm thinking, right? So I'm thinking, I have very little self-storage experience. I'm thinking, okay, you're renting out these basically empty garages. What could there be to value add? So tell us a little bit about that.
We put hardwood floors and granite countertops.
Yeah, that's what I figured. Yeah.
And then just charge them more rent. The value add, it's not a cookie cutter approach, Annie. Each value add strategy is different based on the property. And I would kind of put them into three categories, right? So the first one that probably makes the most sense for everybody is expansion, right? If we feel like we're in a market where the demand outstrips the supply, we may build out an additional, let's say 20,000 square feet of climate controlled storage. And the value add component there really is getting those units full. And that's the growth in income and NOI that we're shooting for, right? So putting a shovel in the ground is one level of value add. Another value add could be what we call management improvement value add. So especially with the smaller mom and pop type operators, there's some ancillary income items that we would consider our low hanging fruit that sometimes just smaller operators don't take advantage of, right? Things like U-Haul truck rental, point of sale retail items, tenant insurance programs. Those are things that require some work and infrastructure to support. And so many times the smaller operators won't do that, but there's nice revenue streams there available for the operator to take advantage of. So sometimes the value add may be that or a combination of those two things. And then the third value add many times is lease up. We'll contract with the seller who maybe is in the midst of an expansion to buy a property at certificate of occupancy or an expansion at certificate of occupancy. So, we're buying, cash flowing asset. Maybe one of the buildings is brand new and empty. And so the value add there really is getting it from zero to occupied. And I think it's very property specific. From Reliant standpoint, we're kind of opportunistic in that there is no cookie cutter approach to everything. It's, hey, here's where we think the value is in the asset. Let's execute on this business plan to do it. Got
it. And so now that we understand self-storage a little bit better and how it works, so let's shift gears and talk about from a passive investor standpoint. And you said you had started out as a passive investor. And so from a passive investing standpoint, if I'm looking at two different opportunities, multifamily versus self-storage, what are some of the things that I should be thinking about in terms of why I should invest in one asset class versus the other? What are some of the things that drew you to self-storage? And then also, what are some of the risks to be aware of?
Yeah, for sure. I mean, I don't know if you can kind of do an apples to apples comparison. They're different asset classes, right? And so, what I always say with investors as we're having conversations is the story has to make sense to you, right? If you've used self-storage for 5 years and you have those units that you never go to and you don't even know what's in them anymore, well, maybe self-storage makes sense to you. I think there's definitely some advantages to multifamily as well, right? Everybody's got kind of their own thing. So it's not like hey, compare, contrast. I think it's more so why self-storage makes sense to a lot of people is the reasons we had already talked about, and most people kind of fall back to this recession resiliency idea. And what's happening now, Annie, is, we've had 2007, 8, and 9, and then through COVID, storage has performed very well as well. So now you have these two really distinct economic cycles that storage has done well in. And so you're seeing a lot of interest come to the space, especially on the institutional capital side, right? The larger institutional investors are saying, oh, this is really interesting. That looks like a safe place to deploy money. So, I think as an investor, it's more comes down to the operator, right? And, the asset class that makes sense and the track record that operator has.
So I have a question. I'm kind of curious to learn a little bit more about, kind of similar to what Annie's asking, but I'm curious about how you all evaluate potential opportunities that you're looking at. Talk to us about that. What are the different strategies you look for? How do you select a market? How do you identify a good opportunity?
Yeah. So, and I hate to give you the answer of it depends, but it kind of depends. So, the one thing that's different, Julie, in storage than, potentially multifamily is the MSA level data, the market level data is not as important, right? With storage, it's the 1, 3, and 5 mile radius around the facility that matters most. Because if you think about it, again, we're renting a garage. So if it's not convenient to work or home, you're not going to travel for a specific self-storage facility. Where apartments you may, right? If it's in the right school district or convenient to, shopping or maybe a downtown kind of nightlife feel, you may travel 15 minutes out of your way to live there. With storage, what really matters is that micro market around your facility. And so, Julie, we're looking at the same demographic trends that any asset class is looking at, right? So population growth and job growth, average income, traffic count at the site, those types of things. But if our acquisitions team was on the line with us, what they would talk about is they try to build a story, right? There's no one magic metric that says this is a great deal. If the supply is under X, then it's a great deal. It's generally true that if supply is under a certain number, it's probably going to be good, but that it doesn't hold true across the board. So what we try to do is take a little bit of information on the market and come together with a story that says, okay, here's why we want to be here. Potentially we've had great population growth the last 5 years, and it's projected to be strong the next 3, right? Because we have these employers in the market. There's 5 competitive facilities in a 3 mile radius, and all of them are 90% full. That's a pretty good indicator that there's strong demand in the marketplace. And, this particular market may also have some geographic considerations compared to the rest of our portfolio, which may allow us to create some advantages when we go and sell the asset where it's tied into a number of other properties that we already own, right? So when we go and sell them, it's not one individual site. It might be a portfolio of properties that we're rolling up, and there's a premium on the pricing side for that portfolio level transaction. So, I think we're looking at a little bit of everything. The one thing I would ask, you and your listeners consider is it's really that micro market or sharpshooters game to find in that 1, 3, and 5 mile radius the key metrics that you're looking for.
So with that in mind, then, as you're looking at new opportunities, are you looking at major markets all across the country? And then when you find a potential opportunity, you're honing in on that micro market? Or do you have specific micro markets picked out and then you just go after the self-storage facilities that are already in those markets?
Yeah, it's kind of a little bit of both. So, we have 48 properties right now in the portfolio spread across 8 states, right? And primarily those 8 states are in the southeastern part of the US, Florida, Georgia, Carolinas, Alabama, Tennessee. And so, generally for us, because we're vertically integrated in managing the properties we own, we're also trying to think geographically about, all right, if we're buying a new asset, do we have the operational infrastructure to support it close by? So usually that's a good starting point. If it's in a market that, we're already in or close by, that's usually interesting to us. And then to your point, Annie, we're digging in once it kind of passes that first eye test. And then there are a few markets that we're specifically targeting, saying, okay, we'd like to be in the Charlotte submarket of, it depends, Lake Wiley, right? Or Midland, North Carolina. And we're seeking out assets in those particular properties or in those particular markets. So it's kind of a combination of both.
Got it. And then you talked about vertically integrated. So I think a lot of people probably are wondering, well, if you're renting out an empty storage unit, is there property management? Is there a leasing staff? Is there maintenance staff? So talk a little bit about that. You guys are vertically integrated, but do you have that? Does that mean you have a property management layer in there?
Yeah, for sure. So Reliant, we have 130-ish employees, and the majority of them are out on the sites, right? Those are the people behind the desk greeting you when you walk in. Yes, it is a garage. Storage is kind of interesting, though, in that it's not just the real estate play. It's like an operating business layered with real estate because the tenant's leases are 30 days. So there's a lot of churn. We're constantly churning tenants, different than multifamily, right? Where, it's a 12-month lease generally. And so you have that tenant locked up. And so, there's a lot of operating business type things that are happening because there's always customer interaction and movement. Think like marketing and just overall tenant service. And, although we don't have, toilets and light fixtures to change in each unit, you'd be amazed when you have 500 to 1,000 units on a property, all of the things that can go wrong along the way. So, it's people have this like a dream of like, oh, self-storage is great. There's no maintenance, no toilets to unclog. Generally true, but there's still plenty of stuff to do. But there have been some operators, Annie, that have experimented with what we would call kiosk models, especially in smaller rural markets where literally there's no people on site and you do everything through a call center and a touchscreen kiosk. And, the goal there is to try to reduce payroll costs to the, bare minimums and maximize the operational. So there's some platforms across the country. A company called Red Dot Storage does that at pretty big scale, specifically in some of the smaller rural markets.
Have you been thinking about investing in real estate, but aren't sure you have the time or the desire to manage the investment? Perhaps you're afraid, like we were, that you'll make the mistake of choosing the wrong mortgage or the wrong team and lose your entire investment. Well, that's exactly why we created the Goodegg Investor Club. We do the work of identifying solid real estate investment opportunities in the best markets around the country and then partner with you to acquire these investments, and then we'll all share in the returns. We'll identify the growing markets, strong, experienced teams, and the solid deals. We do all the heavy lifting of managing the tenants and the renovations, and as a passive partner, you get to enjoy all the benefits of investing in real estate: monthly cash flow, long-term appreciation, and the ongoing tax benefits. When we first discovered passive investing through real estate syndications, we realized it fit perfectly into our busy lives. We could put our money to work for our families, work less, and get more time back in our days so that we could focus on what matters most and discover our true passion and purpose in life. We've now helped hundreds of people invest passively in real estate syndications and are seeing the positive impact it's had on their lives. We invite you to partner with us by joining the Goodegg Investor Club today so you can start putting your money to work for you and get more time back in your day, because we know that when people have more time in their days, they can do the true work they were intended to do, and the world will be a better place. To sign up for the Goodegg Investor Club, go to goodegginvestments.com/invest and we'll take it from there. That's goodegginvestments.com/invest.
Interesting. Yeah, that seems like a great model if you can lower those payroll costs and not have anybody on site, but still provide that same level of service. So I wanted to go back. You said something about churn. So you said most of these tenants are, I guess, do you call them tenants or do you call them? Okay. So the tenants are on a month-to-month lease for these units. Mm-hmm. And so I think there's the downside, right? Because they could leave at any time. But I believe there's also an upside to that. Is that correct? Where you can, you don't have to wait the full extent of the 12-month multifamily lease in order to raise the rent. You can sort of raise it at any month during that time. Is that correct?
Yeah, you got it. I mean, there's definitely risk on the downside in that you can dump out a lot of revenue all at once, right? 30 days. But the upside is if you're in a market that's moving very quickly, you can have rents pace that as well. So, how we think of our occupancy is generally stabilized for us is between 85 and 88% full. And if you're over that, it means your rents are too low, because what happens is, let's say we're 95% full. Well, then I don't have any units to rent at a higher rate for the next person who comes in, right? We're basically full. And so there's no units available. Now in multifamily, that's usually great. Everybody's shooting for that, right? In self-storage, we're kind of shooting for that 85 to 88 and always playing the game of rates versus occupancy with the goal of maximizing the economic occupancy versus the physical. And so what we're trying to do is always have enough units available that we can bring new people in at a higher rate than the person who potentially was in there before. But to your point, it allows you a lot of flexibility in moving revenue quickly, but there's downside risk to that as well.
And do you ever deal with, similar to multifamily, like an eviction or, like the show Storage Wars, like does that ever come into play where you might have a non-paying tenant who's got all their stuff in there? So then what do you do in that case?
Yeah, it's the interesting part about storage, and Storage Wars has kind of, made it a fantasy world. It's not as exciting as the show would suggest, and it's kind of a pain for us. But if you think about it this way, our rents get collateralized with their goods, right? So our bad debt is very, very low as a percentage of revenue. Because if you have a storage unit full of stuff, and let's say, you go 2 or 3 months without paying, and it depends on the state, and we overlock your unit, and then we go and end up auctioning it. And that's what you're describing with that Storage Wars TV show, right? They're auctioning a unit, and depending on what's in it, those people go in and sell all the stuff. Well, whatever you buy the unit for usually reimburses the rent that we're owed. We don't make money on that. So let's say you pay $1,000 and you owe us $500, or someone buys your unit for $1,000 and someone owes us $500 in back rent. We get our $500. We pay the auctioneer, and then the other remaining dollars go to the tenant. We have to, that goes to them. So there's no profit center there. But what it does do is if you evict a person out of a multifamily, out of an apartment, and they don't pay you, you got to go chase them. And there's a pretty good bet that they don't care about their credit at that point, and they're probably not going to pay you. With us, we at least have a shot at recouping some of those back pay rents by selling your unit. And, it doesn't always cover the cost of what the back rent is, but generally our bad debt ratio is very, very small.
That seems like a great risk mitigation strategy. Are there other risks that investors should consider when getting into self-storage? I know you mentioned doing your due diligence on the operator, making sure the micro market. Are there any other risks that people should be thinking about as they're considering getting into self-storage?
Yeah. And one more thing to say just about the auction piece too is it is a great risk mitigation tool, but it's an interesting, it also creates just interesting dynamics on the site when you have 3 or 4 units being auctioned there. It doesn't always look great for other people coming in. Just kind of it's always a balance. I would say the number one risk in the asset class is really new supply. So, in real estate, we're really good at overbuilding things. If people make money on it, other people are going to follow, right? And so storage, especially after 2007, 8, and 9, there's been a very large development cycle through, specifically 17, 18, 19, where there was a lot of new supply being delivered to the market. And really, that's the biggest risk. Pre-COVID, that's what we worried about. During COVID, after kind of Q3 of last year, we went back to worrying about new supply because it looked like COVID wasn't going to have as much of an impact. And what that means is literally, Annie, you buy a facility year 1, and let's say it's a 5-year hold. Well, we generally can underwrite the amount of new supply coming to market day 1, but call it year 3, year 4, there's, if somebody builds a facility down the street, that's a tough scenario. And it's basic supply and demand economics, right? Where if somebody has an empty building, they're going to drop prices to bare bottom to try to get that facility full. And so really, we've had some markets that have been impacted by that. And really, that's the risk you got to be most thoughtful of. We've been fortunate in that all the markets have come back eventually, right? So as those empty properties start to stabilize, the revenues all start to come back up because they have to make money too. And then, we kind of bounce back. But there's definitely a period of time there where it can hurt the performance of the properties.
You mentioned a 5-year hold. So is that typically around the length of your syndication investments? And what happened? What do you guys do as far as the business plan during that time?
Are you saying business plan to exit, Annie, or?
Yes. What are you doing? Like we talked a little bit about the value add. So are you seeking to maximize efficiencies as quickly as possible so that you can turn around and sell it in 3 years? Or is it more of a let's hold it for a while as the values increase and it's a longer play?
Yeah, generally we're going to project a 5 to 7 year hold, somewhere in that range. We've sold 38 properties in our history, and our average hold time is just over 3.5 years. So it's been a shorter term hold. I mean, if someone will give us, let's call what we project a 6-year stabilized value in year 3, then generally we'll look to sell those assets. And, our buyers are generally institutional capital or the REITs. We sold 16 properties last year. 2 of them were to an operator backed by Blackstone, and 14 of them were to one of the publicly traded REITs. So, that's generally been our exit on the backside. The product and the business plan that we're trying to execute has been pretty attractive on the disposition side of things, specifically from the REIT community. So, we'll see as the next couple of years rolls out how much institutional capital interest there is, because there's a lot right now. It's a very frothy market, and we'll see if that institutional interest continues to be there. But generally, that's who we look to on the exit side of things.
Real quick, I wanted to ask Kris, what does the worst deal that you guys have done look like? We always hear about the best deals, right? I think as investors, we always hear about the successes and the wins, but not too often do we get to talk about and dig into sort of the nuances of a deal that maybe has gone bad. So can you talk to us a little bit about that?
Yeah, for sure. Fortunately, we haven't, the worst case scenario is you lose a property to the bank, right? And when a property goes poorly, you kind of look at it with three lenses, right? You can turn it over to the bank, which nobody wants because everyone loses their principal. You can try to refinance it if you believe in the market long term and it just needs a little bit more time. Or, the third option is you can try to redeem out the investors and maybe get a new group of investors in there. So, Julie, what I would say is, from a worst case scenario, we've never lost a property to the bank yet. That may happen. I mean, if you're in the game long enough, it could happen for sure. But I would say that, one of the worst ones that stands out to me is a property that is in the state of Georgia, in Beaufort, Georgia. We actually don't own it anymore, but this goes back to my conversation around the supply side. Literally within a 3-mile radius, in the period of 18 months, we had 3 REIT openings of new facilities in a 3-mile radius, right? And so at that point, rates, it's a free fall, right? It's literally race to the bottom. Who can charge the cheapest amount of money to try to get rentals in there? And for 3 years, while those facilities were filling up, we were just languishing. And that property in Beaufort, Georgia was a great property previous to this new development, right? It was stabilized, had a good cash flow, and revenues were strong. And, it just got in the midst of this new development. And Julie, what ended up happening, that was a property we owned with an institutional partner, a larger private REIT. That got rolled up into a portfolio sale that, ostensibly we sold as part of a package of another package of deals. And, ultimately it turned out okay, certainly not what was originally projected, but that was the one that stands out in my mind as one of the ones that, look, for investors, it's a hard conversation to say when things aren't working correctly. And that one was sort of I'm not sure what you want us to do. We either sell it and take it on the nose now, or we kind of hang on to this thing and see if we can string it out and everybody comes back to stabilization, which is ultimately what we did.
Right. So 2 questions. One, you had mentioned that one of the things that could happen, that hasn't happened as of yet, but that could happen at some point, is that you have to return a deal to the bank. I get this question pretty frequently, and I would love to hear your answer to this question as it relates to storage. What would cause that to happen? Is it decrease in occupancy where you're not able to make your debt payments? Is it that simple? Or what are some of the other factors that maybe come into play where that scenario could happen?
Yeah, I mean, it's a depends scenario, but usually you lose a property to the bank when you can't pay the mortgage, right? It's no different than your home. If you have a mortgage on your house and you don't pay your mortgage, the bank's going to come foreclose on it. No different on the commercial side. I think it speaks to, Julie, why leverage ratios are important, what loan to values you're betting on. The other way it could happen is, let's say you had a 3-year or let's say a 3-year loan on a property and you levered it up. It was an 80% loan to value. And when that loan came due in year 3, there was a correction in the marketplace and values dropped, right? Well, when you look at that lender, the lender is going to call their loan and say, all right, pay us off. It's year 3 and you can't go refinance that property, right? Because your value is not enough to cover that original debt. And so in those cases, you can lose. And that's what happened in 2007, 8, and 9. You had a lot of highly leveraged properties that, even though they were great properties, the values dropped so much that when debt was coming due, you either had to pay off your loan, which most people don't have the liquidity to do, or get a new loan to cover it, right? A refinance. And if your values aren't there to refinance, then it makes it really challenging to do that. So there were a lot of properties in 2007, 8, and 9 that they lost because of that. So, to answer your question, I would say generally it's because of the mortgage payment, occupancy drops or revenue drops to a point where you can't cover debt service. And maybe you make a capital call to investors and, the investors choose not to capital or to bring additional capital in. But for whatever the reason, you can't cover that debt service. And that's really, the worst case scenario from an investor standpoint.
What's the typical LTV that you guys have across all of your 48 deals?
Between 65 and 70%. I'd have to go back. I don't know, Julie, the active LTV right now across the portfolio. I could tell you like the last fund we did was 11 properties at 68%. So generally we're right in that window.
Okay. And then my other question was around the Buford deal. So you mentioned that within a 3-mile radius, there were 3 reopenings of older facilities. How do you, going into a deal, mitigate that potential for risk from happening again? What are some things you look for? How do you evaluate that on new opportunities?
Yeah, for sure. I'd say the first thing is just part of our general strategy, which is, we've really pushed into some of the tertiary markets. And the reason is because on paper, they're not attractive to anyone, right? So if you look at those demographic trends that everybody looks at, right? Everyone knows that Austin is exploding, right? And when you as a developer look at Austin, you're like, I got to be there. But so does 99% of everybody else. And so those yields just get pushed down so far because the pricing is so high. Julie, for us, I would say at the highest level strategy, generally those secondary and tertiary markets are seeing less development at the high end. To answer your question around mitigating risk, sometimes there are municipalities that have put moratoriums on new storage development. So you can go into that market kind of grandfathered in, and they've had so much development in the last 5 years. They're saying, hey guys, no more. We don't want any more of this in our community. Which is great. If you can, if you can find those things, obviously that's fantastic. And then, what we're trying to do is understand generally, if you look on a map, where any new development's coming, right? Especially for storage, right? What those developers are going to look for, and you can see kind of where infill locations are. One of the things that our acquisitions team does is we'll geomap every tenant where they live. So before we buy the property, we can see where the tenants are coming from and then look at the available land and say, okay, if somebody develops here, are any of our tenants coming from there? And there's all these interesting natural barriers that exist, bridges, highways, things that for whatever reason, people don't drive by. If you're on this side of the highway, you do all your business this way. If you're on, the other side of the highway, you do all your business that way. And so that's part of it too, is just understanding where that risk may be. But ultimately, Julie, there isn't a lot of concrete ways to mitigate it, right? If someone's going to buy a building and knock it down and put a storage facility there 3 years from now, if the municipality is going to let them do it, I hate to say, we can't do anything about it, but you can't do anything about it. So it's really always going to be that constant struggle against, the information we can underwrite up front versus what may happen 5 years down the road.
Makes sense. Such great information here. I think a lot of this are pieces that I have put together when we first got into the storage arena, and it's such great information because I think a lot of people just know what we've already talked about, which is that storage is resilient, in the face of a downturn. And so a lot of people turn to storage for that one fact. And they do a little bit of digging, but it's these little nuances that we've been able to dig in today, I think, that really allow people to make an educated investment decision, which is what Annie and I always talk about when we talk about getting into investments, is make sure that you guys are doing your due diligence. Don't just trust what's being provided to you, but really dig. And a lot of the stuff that we talked about here today, I think will give investors the information and the power that they need to be able to make these educated decisions about storage. So such a great conversation. information. Love all of that. So we're going to move into now our impact round, Life and Money Show impact round. We're going to ask you a couple of questions around life and money. So the first question is, what is one thing that you are doing right now to live a meaningful and intentional life by design?
Yeah, it's a great question. So not to get too personal, but I turned 40. I'll be 41 in March. So I guess I'll be 41 in next month. So, it's interesting as you get older, kind of this was a significant milestone I think we all have kind of in our lives, right? Where you're halfway, right? I mean, you're halfway through your life and, rough and tough, I'm probably going to live till around 80, and after that, I don't know how much more I want to live anyways. But, how I think about it is, what do I want the next half to look like? And, Julie, your question around intentional living is something I've written in my journal. And for me, it's really built around, meaningful work and meaningful relationships, right? There's not too much more that's going to matter. I've been fortunate to make some money along the way, and that doesn't make me very happy. But the meaningful work and relationships is really, I think, what I'm trying to build around. And it's the lens at which I look at almost everything, right? So if somebody says, hey, Kris, do you want to do this? Usually that's the first lens, the first check. It's like, well, that doesn't fit in either of those. No, I'm not going to do that. It's made it really easy to make decisions on things because it's a pretty black and white decision-making tree.
Right. I love that. I love all of that. It's so much of what drives Annie and I is being able to say that we get up and we're doing something that's meaningful and we're doing it on purpose. We're not just doing it by default. And Annie and I have really worked hard to, design and strategize our lives around, making that impact, not only in our investors' lives and the community, but also in our own lives with our family too. So I love that. All right. Second question is, what is one life or money hack that you might be able to share with the audience that'll make an impact in their lives right now?
If you've not looked at overfunded whole life cash flow policies, you should. So it's my most recent adventure. And I worked for Northwestern Mutual in college. So I understand life insurance. I was a college intern for 2.5 years. I sold life insurance. I understand the stigma that goes attached to it. But if you frame this discussion as an alternative to cash, not as an investment vehicle, there are some really interesting strategies that you can get involved with. And I'm going to throw a few disclaimers. One, you have to have the right agent who is structuring the policy for this methodology as opposed to maximizing commission. And that is a key component. Happy to pass along the guy that I use if people want to reach out. He's great. But what it allows you to do at a very high level is essentially be your own bank. So if it's money you're going to spend, let's assume, Annie, you're going to invest $100,000 in passive investments this year. Well, once you invest that $100,000, it's gone. You don't have it anymore, right? And what these whole life policies, kind of an infinite banking type scenario, do is you're double dipping. So you can put that $100,000 in the life insurance policy, and there's some cost there, right? Death benefit, you're paying insurance costs. I understand that, but you can lend against that cash value. You're still making the coupon in the policy. You're taking that interest rate from the bank who lends against it. It's tax write-offable. And you can take that money and go invest it in something that hopefully is going to produce income. So you're double dipping. You're still making money on your original money, and your money's out deployed doing something in a passive multifamily deal or self-storage deal. So that's my most recent, I guess I would call it, investing hack. I don't know if it's a hack, but it's just me educating myself. There's a book called What Would the Rockefellers Do that really does a good job of explaining this whole methodology. And happy to direct people. I don't sell life insurance, but happy to direct people to do if they're interested.
Love it. Yeah, that's definitely something that we've talked about multiple times here on the Life and Money Show. We've had a couple of guests talk about life insurance. Both Annie and I use it as well to give all of our investments a little bit of a boost. And we also most recently did a webinar with one of our favorite life insurance guys to talk about how it works. And you're right, you hit the nail on the head. The biggest thing is make sure that you are working with somebody who knows how to structure the policy in the way that you want to use it. Because if you don't, then it totally negates the whole purpose of setting it up. But I love that. Love that so much. Like I said, Annie and I both believe in it and do it as well. All right. Last question is, what is one thing that you are doing right now to make the world a better place?
Yeah, that's a good one. I think that's one of those kind of intentional things. I mean, from a volunteering standpoint, is we have 2 kids, we have 2 boys. So, I hate to use the word busy, but that's what we are, right? It's just busy. And so I think the best thing that we can do right now is a little bit of time and a little bit of money. That's generally where we're deploying capital and human capital to try to make the world a better place. There's a couple local community charities here in Fulton County, Georgia, where we are that we participate with on both sides. And, the impact is palpable. We try to think about our charitable stuff based on the community that we live in. So that's where we like to deploy the time and capital.
Love that. Community is where it's at. And, Julie and I are in the same boat with young kids. So yes, we definitely can understand that busy lifestyle, but love that you're still taking time to lead by example and show your kids how to give back as well. So Kris, we've talked a lot about self-storage and whole life insurance. There's so many different things today. I'm sure our listeners are going to want to follow up with you and learn more. So what's the best place that they can go to follow up with you and dig in further?
Yeah, our website's probably a good place to start, reliantinvestments.com. If you're trying to reach out and learn more about the platform, investment opportunities, those types of things, certainly the website's a good place to start. And, there's all kinds of contact us buttons and you can get in touch with us. We're pretty active on LinkedIn too. If you just Google Kris Benson, LinkedIn, Reliant, somewhere like that, you'll find our profile page. We do a fair amount of posting there. I don't talk about whole life insurance there, but maybe I'll start. I should have came to your webinar sooner, and then I would have been ahead of the game. But yeah, those are probably the 2 best places.
All right. Excellent. Well, we'll have all of that for our listeners in the show notes. Kris Benson, Chief Investment Officer for Reliant Real Estate Management. Thank you so much for being here with us today, Kris.
Thank you, guys. Appreciate the opportunity. Hope you have a good rest of the day.
You've been listening to The Life and Money Show, the #1 podcast for people who, like you, are living a meaningful and intentional life by design, building true wealth, and making an impact in the world. For more resources, check out goodegginvestments.com and be sure to join the Life and Money Show community on Facebook. And if you got value out of the show, please subscribe and give us a 5-star review so we can continue to bring you amazing new conversations.